Well, I think has worked well is the balance within insurance companies of longevity and mortality exposure under the same roof. That's been a very prudent strategy. I think the risk selection has been another attribute that has been helpful for insurers. What didn't work well is the regulatory risk. The extent to which non-economic capital emerged in regulatory regimes, especially in Western Europe, that was onerous. And while reinsurance strategies have helped to mitigate that, that has been a difficult path that insurers have had to navigate. There's a plus and a minus to that transparency. To the extent that there's greater transparency from an insurer's perspective, that would create more of a competitive dynamic that would be challenging, especially in an environment of very low rates and a regulatory pressure. Right now, the viability of some of these products is at risk. So I don't think this is an environment where that would work well. I think from a transparency perspective, the drivers of the costs of mortality or longevity products are quite clear in terms of lifestyle, behavior, health, and that those drivers consumers already understand well. It always feels like that it's 5 years away, and the challenge, of course, is longevity risk is a long-dated risk. It takes 5 to 10 years for longevity improvements to emerge, for which there's really solid data, and very often capital markets capital is not 5 to 10 years patient. And I think that's one of the barriers. Now, to the extent that there is real longevity exposure in the world, having greater sources of capital would be really valuable. But under the current construct, the capital markets don't seem to have the appetite for that long-dated investment. Yeah, that's a very challenging combination. Those low rates are like termites in the basement in terms of the core of those products. What insurers are doing is they're having very disciplined asset liability management, so that should rates rise, the insurers wouldn't be exposed to that. There is a change in products, either terminating some products altogether in terms of their offering, or changing the nature of the products, either reducing the guarantees or eliminating guarantees that are costly in this environment, or using structures. An example would be rates have been ultra low in Japan for so long. Products in Japan have migrated from yen-denominated products to dollar-denominated products, for which there's greater yield that can support the underlying product.